All right. Today we are here with Marlin Beitzel. And before we go too far, I said that correctly,
You
right?
did. You got it. Beitzel.
Okay.
You
All
got it.
right. Perfect. Today we're going to be talking about the mortgage market, the loan market, some of the hacks of real estate that we can get into, some of personal experience, a little bit of everything. But just getting started, can we talk a little bit about where you are, what you do, and your background in the industry, how long you've been doing it?
Sure, absolutely. So I am a mortgage loan originator. That's what I do for a living. But I've been investing in real estate myself for many years. Bought our first home back in the 1990s. But then quickly turned that into a rental property and have kind of acquired different rental properties, done some flips over the years. But I've been in the mortgage business for now 12 years and do a lot of residential mortgage work.
Gotcha.
Yeah, and I'm here at Integrity Home Mortgage in Winchester.
Gotcha. I was looking at a townhouse in over off of 7.
That's right.
And I think it was $120,000, and I thought it was way overpriced.
Yep.
And didn't want to touch it. And I sat down with you, and I was like, oh, I think I'm gonna wait. I regret it now.
Yep.
For sure. That would have been a good property to have. But
yeah, especially when you're a first-time home buyer and you start looking at these big numbers, it looks very daunting.
it's intimidating. It
Yeah.
can be. Yeah, for sure.
Mm-hmm.
But you guys do a great job with everything that you do. And I know in the last couple of years, especially with data being more readily available, more accessible, there's so many more things that are now opening up for people that they haven't seen before. So many more options of wealth creation that are opening up. And I think that's kind of what we're going to get into today and talk about a little bit. So I know we wanted to start just talking about the strategy of an investment. If you want to go through your perception of taking a $20,000 investment and
Sure.
comparing that side by side to some of the other options that are available and focusing on real estate.
Sure. So, when you start thinking about investing in the future, real estate can be one great way of investing in the future. Another way is to put money into the stock market or
Right.
to invest in gold, you name it. If you're talking about investing, you're really looking for something that is an appreciating asset. So it's something that you're not just putting your money under the mattress and hoping to get it back someday, but rather you're wanting to have some kind of return on that investment. So, you start with something simple like taking the money to the bank. And these days, banks are paying a little bit more, but it's still not keeping up with inflation, that's for sure.
Right.
That's a key aspect we want to talk about today is inflation. I kind of go back to when I was a young guy. My wife and I were like, okay, we got to live somewhere. And who doesn't want to have a place of your own? So you look at buying a house, and is that going to be an investment for us financially? Or do we buy a home just because we want a place of our own? And both can be a great reason to buy a home. And I think especially for your primary residence, you got to be careful of those two things. You don't want to get over your skis, if you will, on the financial side of things, and now it causes you personal pain.
Right.
But so talking about investing in general, if you take $20,000 and you invest it at, let's say, 6%, what the numbers will show is over time you're going to have somewhere around $100,000. If you take 30 years, $20,000, and you're earning 6% return on investment, you'll end up with around $100,000. If you can jack that up to around 8% return on investment, now you're going to have about $200,000. So just that 2% tweak in your return on investment is going to double that money again over time, where 30 years from now you'd have $200,000. If you take that up to around 10%, now you're up somewhere around $350,000 would be the total. If you take that same $20,000, you put it to work 10% year over year, and that's just the magic of compounding interest or return on your investment.
Right. Right.
So that's how compounding works. Now you look at where do we put our money? So you could put in the stock market, and in general, stock market since 1957, I got the figure here, it has returned 10.67% return on investment since 1957 until the current. So that's not a bad return on investment.
Right.
Right. So when we think about real estate as an alternative, it has some benefits for us in the fact that, first of all, you got to live somewhere. So if I can enjoy putting my money somewhere that gives me the flexibility, I'm no longer living in mom, dad's basement, or I'm no longer paying someone else's mortgage in rent, and now I take that same $20,000, if I can get somewhere around 10% return on investment and enjoy my living situation, that's a win to me.
Right.
Right. So there were a lot of ifs there. We need to think about, can you really get that kind of return on investment in real estate?
Yeah.
So that's kind of how I approach that question. When you think about real estate, there are several different wins on the financial side of real estate. So the first part of it is, in the United States, the federal government wants people to own their own homes. They really stack the deck in our favor if we're thinking about owning a home rather than renting a home. Now, what do I mean by that? Well, first of all, there's a fairly low barrier to entry in home ownership. In many countries, that's not true. It's difficult to own real estate. If you think about when our country was first founded, it was difficult. Not everybody was owning real estate. But now there's so much federal involvement of giving incentives where they're going to say, do you want to buy a home? You've got no money down? Great, we can help you with that. You have okay credit? We can help you with that. So even if you have a few $1,000s scraped together and you can prove that you've got some stability in your work environment, you could own a home with very little money out of pocket. So that's number one. Second, the federal government subsidizes mortgages. You'd say, well, wait a minute, are they going to pay my mortgage? No, but what they've done is kept rates relatively low. Even if we're in a 7% rate environment, that's low when it comes to asking somebody else to foot the bill for a $200,000, $300,000, $400,000 mortgage or purchase, and I'm putting very little into it. Maybe no money down, or even 5 or 10%. If you go to the private marketplace and you say, I want to borrow money and I've got nothing to put down and no history of having owned something like that before, people will laugh you out of the office. But that's what the federal government is doing, is keeping those rates really low. And therefore, what they're trying to do is create stability in the real estate market. It's not always stable. It's not for the faint of heart, because you may see some losses, but that's generally the environment that's been created in real estate in the United States of America.
Well, and comparably too, you see losses in any industry. I mean,
Absolutely.
When the real estate industry took a tough hit in 2007, 2008, stock market took a tough hit. It was a rough time for everybody. So, I'm not saying you can necessarily compare them side by side, but in relativity, both were struggling. So, it's not that there's one safe haven that you can put your money in and guarantee that every year it's just going to be kicking and rolling. So it's good to have those options. And then, we can get into now what those options look like.
Yeah, and investing always will have risk. All right.
Yep.
But not investing has risk as well, because you think, okay, I've got $20,000. What am I going to do with it? Put it in the mattress? Is there risk there? You bet there is.
Absolutely.
So there's the obvious risk, the house burns down and now my 20,000's gone. But there's also the risk of, what if I got 20,000 today and I put it in the mattress and I pull it out in a year from now? That 20,000 is worth less. That's called inflation.
Right.
All right.
And we're seeing a lot of that
Absolutely.
conversation going on in the news, that inflation is rising at a pretty high rate.
Yep.
So it's tough, just keeping the money in the bank is, like you said, a risk as well.
Yeah. So what you want to do with your investments is to say, let me get into a investment space where I know what the rules are. It's kind of predictable, and I can count the costs, and then I can also make sure that I'm kind of hedging against that risk that might be there. And with real estate, one of the ways you hedge against that is you do a decent down payment if you can. All right. Another thing you do is you have a little bit of money set aside as an emergency fund, because if you buy a house and now the water heater goes bad, Yeah, that's a risk. You're going to have to
Right.
take care of that. But when you think about getting into a home from the mortgage side of things, one of the biggest things I hear people say all the time is, "Well, I'm not in a position where I can buy right now." All right. I truly believe that investing in real estate is one of the best financial bets you can ever make. All right. Your other options are investing in stock market, and there you are investing a lot in real estate as well if you stop and think about it, because you're investing in U.S. companies for the most part, and those U.S. companies, they also have real estate, but they also have a return on investment where they are earning money with your money that you've put in. So in both cases, you're investing in an asset that over time should be kicking back more than what you put into it. That's really what it comes down to.
Right. And I guess you could take a look and in the real estate investment world, essentially that would equate to almost like a cash flow. Whereas with stocks, you're talking about dividends, you're talking about some sort of payoff from those stocks. One of the interesting parts, and I'll reference another talk that we're doing in the tax portion that is huge, and I think it's important to understand and focus on, is that when you choose to, and you can talk a little bit about this, first time home buyers, but when you choose to sell stock to pay for something, a lot of times it is very expensive. You pay capital gains tax on that. So I guess we should go through what are those benefits of having real estate, and what does it look like to avoid some of those tax penalties that we see in the stock market.
Sure. So first of all, I would say don't buy real estate if you're looking for something for a year or two. There are costs for entry and exit on any investment.
Yep.
And for me, if somebody says, "Hey, I want to buy a house," first of all, I don't like where I'm living, so I have that need. I'm pretty sure I'm going to be at the same location, job, circumstances for at least 4 or 5 years or longer. And I've got what it takes to get into a home. Absolutely, a home could be a great investment. Okay. And by the way, on that, so let's talk a little bit about what does it take to get into your first home, right? So there's 4 parts to being qualified on a home mortgage or on a purchase of a home. Number 1 is going to be down payment, which some loan programs don't require any down payment. Number 2 is going to be your employment or your income. Do you have the ability to show that you've got steady income or employment of some sort? Number 3 is going to be your debt to income ratio. So we're going to look at how much your monthly bills are that you're required to pay versus your monthly income. And then the 4th thing is going to be, of course, your credit situation. People often think, well, to do a mortgage, I really need to have a deep history of credit. No, you can have okay credit and still be able to qualify for a mortgage. So you first look and say, am I in a situation that I want to buy a home? Does it make sense because I'm likely to be in that home or owning that home for 3, 4, 5 years or longer? And then do I have some of those basics to get qualified? And the only way you really know is to talk to somebody like myself who's a certified mortgage loan originator. And we sit down and go through those 4 things. People think they know what's on their credit. They don't necessarily. They think they know what is required as far as their income compared to their debt. But quite often, people really don't have a clue as to where they are on that.
The other thing, too, that I think is a misconception is I was talking to a family member the other day, and it's a younger family member, but they were considering, they've been considering moving out of the house, what does it make sense to buy a property? And what's interesting was their perspective on how much that would affect their personal bank account. And it was a misconception. And I think that's a really important point to harp on a little bit, is that it's in everybody's best interest to go and have a conversation with you, to begin that process, to see what options there are out there, because it's not cookie cutter as it was and as it has been in the past. I know you can probably talk a lot more in depth about it, but after 2007, 2008, things tightened down pretty hard, and a lot of the loan programs that were out there disappeared pretty quickly.
That's right.
But now, as we're getting into a different market situation, the real estate market is strong. It's continued to be strong. The value of property continues to go up, and it's not for a lack of poor loans. It's not that anyone can qualify for a loan, but the people that can, there are quite a few options for them. So
Right.
do you want to go through some of the basics of some of those options look like?
Sure, absolutely. Love to do that. So the two loan programs that would have 100% financing, the most readily available, is VA if you're a military veteran, and second is USDA, which is the U.S. Department of Agriculture. In Virginia, we have a VHDA loan as well, and it's Virginia Housing Department Administration. So those loans all allow 100% financing. And they do have income caps on some of those loans, where if you make too much money, in this area it's somewhere around $100,000. But it depends on your family size. If you got more kids, that you could earn more money. So that's where the federal government is saying, we want to help you buy a home in a rural area, and that could be anywhere around Winchester. So you could get into that home with no money down. All right. Another loan program is FHA. It only requires 3.5% down. And FHA is very forgiving if your credit is not so great. So maybe you had a bankruptcy not too long ago, or a foreclosure, or collections accounts. FHA is designed to help people get into home ownership with 3.5% down. And that 3.5% could be your money. It could be a gift from a family member. You could take a loan from 401k. There's different sources where you get those monies from. Conventional. So if you've got good credit, conventional loans, people often think, I've got to put 20% down. That's not true. You can do 5% down, or if you're a new first-time home buyer, you could do 3% down on a conventional loan, and you can get a fantastic rate. So there are some incentives, again, from Fannie Mae, Freddie Mac, the U.S. government, to help people get in their first home with 3% down, still a great rate, fairly low payment on that. So the barriers are low. Those are some of the loan programs we've got. If you're more of an investor, and you might think, well, I've already got my primary residence, and I just don't have enough cash or income to get into an investment property. There are some investor programs now that what we look at is what is the cash flow going to be on that property, rather than what your income is. So if you find a home that's going to cash flow, that's a fantastic opportunity to get into an investment property where you don't need a huge paycheck coming in order to do that.
Yeah, absolutely. And one of the things we were talking about before we got started here was, looking at the market, I've noticed significant changes in the market to where some of those cash flow properties are coming back on the market. There's a lot of opportunities out there where that's an option. And, I've looked into some of those programs like that, and I like the concept. The concept is great because as people get into investing, what you'll find is you almost want your properties to break even. Mm-hmm. You don't want a necessarily super high debt to income level, because then you're paying more taxes. Mm-hmm. So if you can depreciate your property correctly, and you are maintaining your property, or you buy a property that needs improvements and you're spending that money consistently throughout time, well, yeah, you're not going to make, quote unquote, make so much money on it every year. You're not going to see a huge gain, but that also can limit you when you go to the table if somebody's looking at debt to income.
That's
so
right.
if you're looking for an alternative option, that's a great option.
Yeah, and we're talking a little bit about, so you and I both believe that owning real estate is a huge financial win. And I break that win down into 4 parts, right? So the first part of the financial win of owning real estate is that you are making general payments towards wiping out your mortgage over time. So it is a kind of a forced savings. And again, you got to live somewhere. If it's your primary residence, you're going to be paying down somebody's mortgage.
Right.
So if you are paying down your own mortgage, over time, you're making a little bit of progress every month. And the further you are into that mortgage, the bigger your progress. It starts to snowball. So that's number one. Second is that you're going to have some type of appreciation in your real estate over time. Again, occasionally you're going to see the market kind of trailing off, and you're going to see a little bit of a decrease. But overall, real estate in the United States of America has always gone up when you look at a 10-year period of time.
Yeah.
Even if you look back in 2007, 2008, So if you did get into home just before that, absolutely, your investment went down in value for a period of time, but not as much as people might think. I'll come back to that point in a minute.
Mm-hmm.
And so you are seeing this appreciation over time. On average, that comes out to be about 4.5% over time, depending what time period you look at in the history of the United States. All right. So then that's two pieces of your win of real estate. Your third is your whole cash flow. And that's when especially you get into being an investor. If you're an investor and you can buy, fix up, rent out a property, and the person is paying not only your mortgage, but you got an extra $200 or $300 a month, that's the cash flow piece of that. So you add that to the other two pieces, that's the third. And then the fourth is what you're talking about is the tax win, where again, the code allows us to write off all kinds of expenses, write off your depreciation. So even if you have money that you're earning, so I've got several rental properties. Last year, I earned well over $30,000 or $40,000 in appreciation and paying down my mortgages. So and in the cash flow, but when you look at my tax return, my tax return shows that I earned $5,000 in that. All right, haven't done anything illegal at all.
Right.
The federal government says write off these things, and so now my building wealth of 30 or 40,000 becomes a taxable event of only about 5,000.
And just to interject here quickly, if you want to see more about, what a write-off looks like, you can listen to our podcast or our conversation on taxes and getting into the weeds a little bit, what those tax benefits look like, what write-offs are, how you can use them to your advantage. But that's what I think most people would say that they find is that, like you said, you might have a pretty decent sized income, but a lot of that stuff gets written off because you're making improvements. You're using that money to benefit the property, improve the property, and utilize tools around it. So,
yeah. And I'll tell you, Jack, I think sometimes people listen to a conversation like this and they kind of feel like you guys are trying to sell me on some
of
idea.
course. Yeah.
And I recently did some training for people in the real estate space. And I walked through an example of you buy, let's say, a townhouse to live in. And you put in maybe $20,000 up front. And I think in my example, I bought a $200 and some thousand property. I put about $14,000, $15,000 all in at the beginning. Small down payment, pay my closing costs. And I ran the numbers showing that over time, after 30 years, you would have you would have a property and the income you've taken from it, and you'd be somewhere around $700,000 in wealth generated from that $14,000 at the beginning. All right, and I had people kind of question me on that, and they're like, "I don't trust your numbers, Marlin." All right, and I'll tell you what I used. I'll walk through the assumptions right now.
Yeah.
I used the assumption that the property is going to increase in value 3% every year.
Which is probably average or low.
Conservative.
Yeah.
Right. Vacancy rate for that property, 6%. So 6% of the time, it's going to sit empty. You got repairs that are going to cost you about 10%. So if you're collecting $1,000 every month, about $100 of that, set it aside for a roof, water heater, you name it. That inflation is going to be about 2.5%, and that over time, my rents will go up by 2.5%, but my costs will go up over time by 2.5%, but my mortgage won't, because I got into a fixed rate mortgage at the beginning, which is key.
And that's a huge piece, I think, that we can get into after you're done going through this. Yeah.
Yep. And so when you run those numbers, it comes out to exactly that. You invest up front $14,000, and it turns into $700,000 in 30 years. So when people were questioning me on this, I'm standing in front of a group of real estate professionals and so forth. I started doubting myself. I went back and I looked at my first investment property. First, it was my primary residence, and we did what's called house hacking. We want to come back and talk about house hacking in a minute. And the numbers were right in line with that. I had that property for about a 10-year period of time, sold it, bought a next investment property. The next investment property I've had for 20-some years. The numbers are lining up exactly with what I talked about in my scenario. All right. I've done that now with 3 or 4 or 5 homes. So I look at the books, I look at the graphs, and I get charged up by numbers. I really like digging into those kinds of things. That's good for a mortgage guy. But when I look back historically and owning 5 rentals now and see that that is absolutely true, old guy talking to a young guy and saying, trust me on this, it works. That's why you have so many real estate investors who are trying to tell people, look, get your money started to work for you in real estate. It's amazing what can happen over time.
Well, and I think one of the big things too, looking at from the long-term perspective, is we're not having this conversation to tell people how to become a millionaire overnight. There's a lot of that stuff out there,
Yep.
and most of it's junk. I mean, if it sounds pie in the sky, it probably is. Real estate is not for somebody who wants to make $1 million in a year. I mean, you can. There are people that do that.
But in 30 years,
In 30
it is
years,
for you.
absolutely, absolutely. And in terms of when things are down, talking about people that bought in maybe 2007, 2008, or bought before that, pre that time. I love this. Tony Robbins has a big thing. You only lose money if you sell.
That's right.
And that's a huge mentality to keep in mind when we're talking about real estate, as well as we're not in the game to get people to buy houses and sell them next year. That's not what we're in this for. We're in this to help people create wealth not only right now but in the future. And I think one of the things that my family has noticed is, as you look out, as you spread these investments out over time, yes, you're paying down a mortgage, but the tax benefits, that's one huge piece of it that's really beneficial to people. The other part is that when you look at the end of this road, when it's everything's said and done, and obviously a lot of people choose, I'm going to refinance here, I'm going to refinance there. So that loan gets reset sometimes based on rates. But if you can lock in, and especially if you've locked in the last 2 years when rates were so low and you're at a 30-year at that rate, you wait it out. And when that loan comes to close, all of a sudden, all these expenses that may have felt overwhelming at times, it can feel like a lot when you've got a water heater, a roof, and that same year, somebody's going to, leak the tub, or there's going to be a toilet that needs to be replaced, or it always seems to hit all at once. However, when you look down on that year 30, when you finally get that loan paid off, all of that becomes income.
Yeah,
that
absolutely.
payment that you're making, that equity payment that you're making every month, which is, I would still count it as income again, because it's paying down equity in your home. So if you go to sell that house, you're going to make that money back that somebody else is paying, if you're an investor, paying the mortgage on. But that's the big piece, is once you hit that period of time where that loan's paid off and you're in the clear, all of a sudden these numbers it skyrockets.
Absolutely does.
Because
exponential.
you have this cash influx every month, and you start to be able to realize that yes, it's not an overnight success, but if you're patient, if you're timely, even if you have the ability to overpay on your mortgage and pay down your loan faster, all of that becomes cash flow. And then you have this property that's worth, you have a stock that could be worth, if you bought it for $100,000 based on the rate of return, you have a $300,000 investment that a renter or renters over the course of time have helped pay for. You've kept it, and part of that cash flow has helped pay to keep it, make sure it's on top of it. And now you have that equity in the property, which we can talk about in a little bit, using equity to your advantage, but having equity in that property, and then you have this monthly income, this monthly cash payment, where when you're in your 50s and 60s, it's nice to have those payments that are coming in every month. You want to retire early, you start early.
This is why you invited an old guy in this conversation. Because
Of course, yeah.
I'm 56 right now. Okay. So let me tell you one of the things that I'm starting to see that is a little bit of a different perspective on what you're seeing right now, but you just touched on it. And that is that you're building wealth for the future. But ultimately, when you're then approaching those retirement years, you have to turn that into cash flow. So if you got 10 million bucks sitting there, but you can't access it, what good is it? You can do that with stocks. So that's easily done. So with real estate, over time, you're building up that wealth, you're building up that asset. And ultimately, you want to be turning it into a cash flow. And there's a couple ways of doing it. With rental properties, that is the primary way of having cash flow that, and we touched on briefly, that will be indexed to inflation. So most other assets don't necessarily keep up with inflation. They're not tied to inflation. But a real asset, like a piece of property, is going to go up over time with or a little bit above inflation rate over time. So that's one of the reasons as I'm kind of getting towards those retirement years, say, I want to at some point no longer be doing the W-2 job. I'm going to need cash flow coming in, and inflation could be a real problem. How do I keep up or exceed that a little bit? Real estate checks all those boxes.
Yeah, absolutely. And I think one of the other things I love about it is having that perspective of, and you touched on this in one of your talks, and I just love this mentality. I never thought about it that way. The perspective is you're locked into this 30-year agreement with a bank that says you're going to pay X amount every month. That agreement stays the same unless you refinance or unless you change something in the loan. That agreement stays the same. Now, that rate, that amount that you're paying, the value of the home at that time that is designated by the amount that you take out to purchase it, all of those numbers steadily will increase based on the data that you've pulled over time. Those numbers increase as inflation creeps up as well. So you could make the argument, well, it's leveling it out. Well, in the investment world, this is why I love real estate as an investment. In the investment world, the perspective you can take is, well, if the price of everything is going up, I'm going to raise my rental prices to keep up with the market. If we look at the market today, the rental market today versus what it was 5 years ago, there's a high need for rental properties. Yep. People need places to stay. And throughout the beginning of COVID and now tailing off, as we see prices kind of steady and the world start to kind of come back to where it was before, inflation is still high because we wrote checks to everybody. Yep. Everybody got a check. And so as we're paying for that, we're seeing it in the market. And there's a misconception that every single rental property is owned by billionaires that are sitting out there and they have all this money. That's just not the case. Yep. And the reality of it is the market dictates what the price is of something.
That's right.
As real estate professionals, we often will say everyone wants the maximum amount for their house. And that's what you should do. You should try to get the maximum amount that somebody's willing to pay for your home when you list it. But the market will tell you whether you want too much for it or not.
Yeah, and what you're really saying, Jack, is that inflation is your friend.
Absolutely.
And that's kind of a weird concept because everyone's like, oh man, all the prices are going up all the time. But when you're investing in real estate or something similar that's a real hard asset, inflation is your friend, especially because you bought the product you're selling back when prices were lower, right? So you hear us old fogies talking about, well, the price of bread and milk and gasoline, all that when I was a kid was this. Well, if you think about it, I bought my rental property 20 some years ago. That is fixed. That cost has not gone up, but I am selling my product at today's rates. That has got to be a huge win.
Yeah.
So inflation becomes your friend over time. Immediately, not so much, but over time, when you own real estate for a longer period of time, it becomes even more your friend. If you don't mind, I'd like to talk about, is now the time to buy real estate?
Of course, yeah. I love this conversation.
Yeah. People will kind of say, man, prices have really gotten high and interest rates are high. I'm not sure if now's the time to buy a house. Well, I go back to what I said earlier. You need to live somewhere. Are you in a situation where you want to buy a house? Can you afford to buy the house? And are you going to live there for 4 or 5 years or longer? I hate to tell folks, but prices aren't going back down. Will we see a little bit of softening? Yeah, and we've seen that. They kind of leveled out. But by the way, we just saw some new figures out coming this morning. They're starting to inch back up again. Okay, and that's what we actually absolutely anticipate happening, is we're going to be some leveling off. But if rates go back down again, so as we're recording this, we're around 7% on the interest rate.
Mm-hmm.
If it goes back down to 5% tomorrow, what do you think is going to happen to the price of those houses?
Prices are going to go up.
They're going to skyrocket. So we're not going to see prices going down. If you need a home, you need some place to live, and you can afford it at today's rate, it's a great time to get into it. If you can't afford it, don't do it. Don't get out over your skis.
Right.
If you get into that agreement with the bank that we're going to pay 7%, you're saying, I can live with that. You do have potential opportunity to refinance in the future. Don't bank on it. Don't say, well, I know I'll be able to refinance in 6 months from now or a year from now. No. But quite often, because things are cyclical, rates go up, rates go back down, that becomes a bigger win than again in the future. My first rental property, we were at 6.5% when I bought that thing. And I thought, I have to buy it because rates will never go lower. Over time, they went down, they went down, they went down. I refinanced. And it changed my cash flow significantly. When rates went back up, it didn't change my cash flow at all because I was in that fixed agreement. When inflation kicks in, boy, it's just the cherry on top.
Yeah.
Because it just got better and better. The other part of is now the time to buy. Okay. If you go back and look at 2006, 2007, I think everyone would agree historically in the U.S., that would be the worst time to buy a house in the United States. All right. You look back historically, maybe Civil War, I don't know.
Yeah.
But in modern times, that was the worst time to buy 2006, 2007. So you look at values then went up, they went crashing down, if you will, and you'd say, well, how long would I have had to have lived in that house to get back to even? If you run the numbers on that, it's 10 years, right? So from when you would have bought at the peak until it went down and then back up to where you were was a 10-year period of time. And people are saying, holy cow, during that whole 10 years, I was upside down. But were you? Because you have to live somewhere.
Yep.
If you look at what you would have been wasting during that time in paying your rent, and you factor that in, you get back to break even in 4 years. Okay? And I can show you the numbers on it. It is absolutely true. If you factor in what you're wasting on rent, if you bought it the worst time ever, you get back to a break-even period after 4 years, not 10 years. So let's suppose we're getting ready for a crash. I don't think we are.
Mm-hmm.
But if that happens, and if it's as bad as it was in the worst time in the United States, in modern times at least, then if I'm going to live in my house for 4 years, I should buy a house.
Yep.
As long as I need a house, want a house, and I can afford the house today,
Right.
buy the house. Live there for 4 years, it's almost certain to be a win.
Yeah.
Yeah. Very compelling.
Well, and I think one of the other things I want to circle back to is talking about tax benefits and how taxes come into play. I know one of the big things when you did your real estate conversation with all of us real estate professionals was being able to sell your first home and not pay taxes. It sounds like a hack. It sounds like something that's cheating the system.
Yeah.
So can you go into that a little bit and tell us a little bit more about that?
Yeah, so let's talk about a couple of things around that. I get this question all the time. So one of the first questions I get is, all right, I bought this house 10 years ago. I'd lived in it for 10 years, and I'm going to sell this thing, and I'm going to get a check for $150,000. How much am I going to pay on taxes on that? Generally, and there's some nuanced rules, check it out with the IRS, but generally you pocket that money. So Uncle Sam has said you've lived in your house, you have earned $150,000 while living there or more. That money is tax-free to you. Do whatever you want to with it. Buy another house, but you don't have to buy another house. Now, let's talk a little bit about house hacking. One of my favorite house hacks is you buy a primary residence. You live there for at least 2 years, but maybe longer. And then you move out of that home. You move to a new primary residence, which gives you a great mortgage, maybe with only 5% down in your new residence. Turn the old one into a rental property. People ask me all the time, is that okay? Sure is. Do I have to refinance? Nope. Do I have to tell anybody it's an investment property, my interest rate goes up? Nope. That's one of the ways the deck is stacked in our favor with real estate in the United States. So now you've lived in the new house and you live there for 3 years and now you sell your old rental property. You still get that tax break. where you've earned that $150,000, $200,000, Uncle Sam says, congratulations, do whatever you want to with it, right? Again, look at the IRS tax code, talk to your accountant, because there are some nuanced rules, but for most people, that's how it works. Now you live in the new house for 4 or 5 years, and you do the same thing. And so that money is true earning that becomes tax-free. Or if you have a basement, you fix it up, or a room, and now you're renting that out to a college kid or a relative or you name it. Those monies can be tax advantage, right? Then if you start into investing in a property and you're keeping it longer and you've never lived in it, right? That's where your accountant friend will start to talk about you can take off depreciation, etc. But even after you own a property like I have for 20 some years, if I now want to sell that property, there's a 1031 exchange. And it gets really complicated, but you can pretty quickly say, I want to move that money into another property and continue kicking that can down the road on the tax bills. Right now, ultimately, at the end of the game, you're either going to pay taxes, but you do it. It's like a Roth IRA. A Roth IRA, you have all this money that later you're going to be paying some taxes on, or a traditional IRA that later you're paying taxes on. There's tremendous value in that where you're not paying it in today's dollars.
Yeah.
And by the way, one of the best ways to get out of real estate taxes is to die and leave it to your heirs, because now that goes up to the new reset value. They pay nothing on everything you've gained over time.
And we had this conversation with our accountant friend that was in here. If they sell it at that day, they pay no taxes.
They pay no taxes.
So everything gets reset. The other thing that's nice is if you have kids that are interested in, this is such a fun topic. I love having conversations with people that understand finances and understand how to deal with the system in the best way possible. We get to this question of, oh my gosh, I have 5 rental properties. What am I going to do? My kids are going to have to pay taxes on it. And again, we go back to, we've had this conversation with our accountant, but even depreciation gets reset. Mm-hmm. So if you've paid down your concern because, oh man, I've taken all this depreciation. Well, it's almost like an entire reset.
Yeah.
The entire house gets reset back to square one. So the kids then get the depreciation tax benefit. They get the fact that they're not paying any money to taxes if they sell it at that price. So it's a great even financial tool to teach your kids about money.
Absolutely.
To teach your kids how to manage money and choices that we make in the everyday world. Is it better to sell this house now for $500,000 or the loan's paid off? I'm going to sit and I'm going to collect, let's say if it's a $500,000 house, probably $2,200 a month conservatively. Yeah. Say $2,200 a month. Which one are you going to take? What are the benefits? And then we get to just run those numbers and teach them that lesson. And then it creates a whole nother generation of education and knowledge of people that understand these things and can go out and be effective with it.
Something occurs to me as we're chatting here. You and I are now starting to nerd out in all this real estate speak. We're talking about depreciation, tax benefits, and all that kind of stuff. And that's great because all these are true. And over time, we have learned these. I think back to how we started this conversation was about me buying my first house.
Yep.
Okay. And when I think back, I was a teacher at that time. All right. I didn't know a lot about real estate. I didn't know about all these benefits and the numbers of here's where you get this part of the win and you can do a 1031 exchange and all that. All I knew is I wanted to live somewhere. I wanted to have my own home. It's kind of the American dream. It still is. And people told me over time, you're going to win financially if you do that. And I met a great agent. You're a great agent, right? Mm-hmm. And I met a mortgage guy, and they talked me through things, and they helped me get started into that. And then I was thinking about renting that home out and buying another one. And I had a friend who had multiple investment properties. I said, could I buy you some coffee or lunch? And so my wife and I took them out for dinner. And he pulled a fast one and paid for dinner, so I didn't even get to do that. But what I learned from him was so rewarding, and it helped me take the next step. So I guess that's the thing I would would mention to people who might be listening to this is you don't have to understand everything. Start with where you are. Do I want to own real estate? Do I see the financial win of it? Can I talk to a couple of professionals who will get me started with what is in front of me today? All right. Then once I've done that and I see this is actually really working, if I want to take next steps, I do. If I say, you know what, I tried this landlord thing, I don't like dealing with people who are calling me in the middle of the night with a leak, in the bathtub or whatever it is. That's fine. It's not like it's easy. It takes work. It takes investing and making those risk decisions. But that's how life is. Everything takes risk decisions. And we've just learned over time that is a very key way of building wealth that you can do in addition to your W-2 job that you're doing every day. And it's fun because it's different.
Right.
I don't want to keep doing my same job and working 60, 70, 80 hours a week. But when I can do that and on the side, do a little bit of a side hustle, and it's fun and interesting, and I get to use my hands to do some things, it's been a great ride for me on that.
That's awesome.
Don't try to learn everything.
Yeah.
Just take the step that's in front of you.
And I think one of the other big things too is most people, we don't want another headache, right? Everybody has enough headaches today. And we're going to talk more, and we're sitting down with Misty and Mandy to talk about property management, rental property managers. So there are avenues even for that. But I think you hit on the biggest thing, which is just having that passive income that eventually can become your primary income. Mm-hmm. And hitting that point, I see a lot more of it going on today. Well, I'm generally young, but I can't remember paying attention and hearing a lot of people that were doing it. Now there seems to be more that are getting into the game. But being able to retire at a younger age, having more options, financial options available to them, and having equity and cash flow at the same time. I think it's really cool for people to be able to pass something along to their kids, and real estate is a great avenue for that. Yeah. Not just the tax benefits, but just the mentality of, hey, I've owned this, I've paid it off, I've worked hard to pay it off. Now it's something that you can make that decision with and see how you want to treat it.
Absolutely. Can I mention a little bit about the whole retire early? So we're talking
Absolutely.
about the FIRE movement here, financial independent, retire early.
Yeah.
So some of those folks recently have been kind of caught in a little bit of a lurch because many in the FIRE movement were investing in stocks or crypto, you name it, and they now need to turn that into cash flow. And that all has been working great because we've been in a rising market with stocks, with crypto, with everything. But then suddenly the world changed, all right? And during that time, you had inflation suddenly kicking in. And again, if you're looking about firing and you're retiring early, and you're retiring at 40 or even 50, you got a long time ahead of you. When inflation kicks up from 2% to 6% or even 9%, that is a huge change in your FIRE calculations. But if a decent portion of that wealth, and for me, I like to be about 50-50, 50% in real estate, 50% in other things. If a decent portion of that wealth is over here in real estate, and when the inflation goes up, that real estate is going up with it, and your cash flow is going up with it, it is your hedge when you're trying to FIRE that allows you to continue to do that for 30, 40, 50 years in the future. If you truly are in that FIRE mentality and you're trying to retire early, you've got to have a plan that's going to be longer than a 5-year plan.
Absolutely. Yep. All right. Well, this has been awesome. Thank you so much, Marlin, for sitting down with us. And
It's been a pleasure.
We'll do it again soon.
Absolutely. Thank you.
All right.